Hi, I'm Stuart Chamberlin, president of Chamberlin Financial in Boca Raton, Florida. Let me ask you something. Do you believe, generally speaking, that history tends to repeat itself more often than not? If you're like most of the audiences that I speak in front of, you probably answer yes. Why is this so important? It's important because I was able to use market history in the late 1990s to predict that we were going to go into what probably would be a 20-year or longer secular bear market. I also used historical market evidence to predict that in 2007 we were going to have another major drop around the corner. As it turned out, in classic style, the second drop was much bigger than the first. What if I told you that my business partner and I jog on average 10 miles a week? You'd probably get a picture in your mind in the summertime we're wearing shorts and t-shirts while out there jogging, and in the winter if we lived up north we're wearing hats and gloves and warm clothes. However, what if I said that the way I derived that 10-mile average was that my partner jogs 20 miles a week and I don't jog at all? Now, did I tell you the truth when I said on average we jog 10 miles a week? Of course I did. But did I tell you the whole truth? No, I didn't. And once you know the whole truth, doesn't it paint a totally different picture? This is akin to when an investment broker tells you that the market outperforms other options over the long term. Have you ever asked that broker how long the long term is? What kind of return on investment is the stock market said to yield over a very, very long term, such as 100 years? The answer usually runs in the neighborhood of 8% to 10%. Let's split the difference and say it's 9%. Over the very long run, 6 to 7% of that comes from growth and 2 to 3% comes from dividends. However, what if this 6 to 7% came in clumps? What if historically there were huge periods of time where the market yielded zero growth and huge periods of time when the market yielded double-digit growth? Lastly, what if these periods alternated throughout history in a very predictable and repeatable fashion? If this were true, as an investor, would you want to have access to this information? Once more, if you're like most of my audiences, you probably nodded your head in affirmation. So let's go back to the beginning of the 20th century. We had a bear market zero growth period that started in 1899. It existed all the way until 1921. We had a 22-year bear market cycle with zero net growth. During that period, there were lots of good years and bad years, but the good years and bad years all washed each other out, resulting in zero growth. Then we had a great period in the stock market from 1921 to 1929 called the Roaring Twenties. It was a great time in our country, but you know that came to a screeching halt one day in 1929 when the market crashed. Then we went through a period from 1929 to 1954, a 25-year bear market, again with lots of good years and bad years. But the good years and bad years all negated each other, resulting in zero net growth. Then we went into a period from 1954 to 1966, when the markets did well. Some of you might remember that period when America was on top of its game. That ended in 1966 when we went into another bear market, one of the shortest in U.S. history from 1966 to 1982. That was just shy of a 17-year period where, again, the good years and bad years all washed each other out, resulting in zero net growth. The rest is history. When the stock market took off after 1982, and between then and 2000, we had the best bull market in U.S. history. Despite this, we all know what happened in 2000 and again in 2007. So according to history, roughly how long is the average bear market? If you guessed 20 years, that's right, about 20 years or so. One was a bit shorter, and most were a bit longer. You can see that bull markets, the good times, are typically a little shorter. So how long is it when your investment broker says the stock market outperforms over the long term? The answer is 35 years. By the way, Take a guess what the market cycles looked like back in the 1800s. If you guessed that they looked similar, you'd be correct. Throughout history, we've consistently had roughly 20-year bear markets followed by shorter bull markets followed by bear markets and so on. This would imply that in 2013, when the stock market broke through its ceiling that had existed since the year 2000, this would be the end of a secular bear market cycle and the beginning of a new secular bull cycle. However, many question this, pointing to the unprecedented level of artificial stimulation that helped the market along. So, is it possible that this is the first time in nearly 200 years the stock market recovered after only 13 years? Well, of course it is. Anything is possible, but hopefully what you're asking yourself is it probable? According to market history, the answer is clearly no. So it was because of my own research of market history that I was able to predict in the 1990s that we were about ready to go into another secular bear market. How did I know the time was nearly at hand? I'll talk more about that in my next video. But in the meantime, you're probably saying, okay, but that means we have perhaps 6 to 10 more years of a bear market. But what does that really mean? I said earlier that I also knew in 2007 there was another drop around the corner. How did I know that? Well, every secular bear market we've had in this country has had 3 or more major drops. Again, how many have we had so far since the turn of the century? That's right, only 2. We have not had the third drop. Also, it doesn't always happen, but oftentimes these drops get sequentially larger. In other words, the second drop is bigger than the first, and the third drop is bigger than the second. There are a lot of reasons for this, which go beyond our video today, but it did turn out that the second drop starting in 2007 was larger than the first drop from 2000. The question now is, when will this third drop happen, and will it be bigger than the last? Also, how will it affect you if that happens? In our next video, we'll talk about how I knew that we're about to slip into a 20-year or so bear market cycle in the late 1990s. But before we call it quits for today, I want to take this moment to answer a thought that might have crossed your mind at this point. You might be thinking, I have never heard an analyst in the media talking about 20-year bear markets. Most of the time, they'll say that a bear market is 2 years or 3 years. So why do they say 2 or 3 years and Stuart Chamberlin says 20 years? The simple answer is that we define the words bear market and bull market differently. They talk about something called a cyclical cycle. On the screen, you'll see an overlay of the last bear market we had from 1966 to 1982, one of the shortest in history. What they will do is say that this first drop is a bear market. This recovery is a bull market. The second drop is a bear market. The second recovery is a bull market, etc., etc. That is a textbook definition of bear markets. These are also known as cyclical bear markets. The problem, however, is that my clients live in the real world. They tell me virtually every day that as far as they're concerned, if they're going for a roller coaster ride over a 20-year period and netting 0 growth, it's part of one big bear market to them. So analysts are defining bear markets in cyclical terms, textbook terms, and I'm defining them as secular cycles or real-world bear market cycles. So why do analysts and most of Wall Street like to talk about cyclical cycles? Well, it's important to understand that Wall Street knows they can make more money and get more people to invest in their products when people are optimistic and think the markets are going to do well. In fact, in many ways, I think that Wall Street is partially in the business of selling optimism. The reality is that if they talk about short-term cyclical cycles, they can speak optimistically about the markets more often. After all, what sounds better? The market should be turning around and recovering sometime in the next year and a half? or we're going into a secular bear market for roughly the next 20 years. So hang on to your hats. The answer is obvious. Stay tuned for our next video when I'll talk about how I knew that 2000 was near the time when we'd go into a secular bear market cycle and that 2007 was about the time for the second drop. I'll also discuss what strategies you can utilize to protect yourself from this third impending drop. So don't miss it. I know we've covered a lot of information in this video. If you have any questions about anything I've covered, please do not hesitate to give us a call or send me an email, and we'd be happy to set up a free financial consultation to determine if you've done all you can to preserve, protect, and grow your wealth.